Welcome to the deep dive. Ever felt like you're navigating personal finance with maybe a blindfold on, bombarded by generic advice or even worse, biased opinions?
It's a really common feeling, like being adrift in this sea of financial jargon.
Exactly. So today we're tearing down that confusion. We want to uncover the surprising truths and, the practical strategies that actually work.
And our mission for this deep dive is really to cut through all that noise. We want to give you the clearest, most actionable insights, pulling directly from a really comprehensive expert guide.
Absolutely. And this guide, it's packed with real-world examples, those kind of inside tips that are so often missed or just frankly poorly understood.
Yeah.
We're talking about equipping you with the knowledge to make truly informed decisions, avoid the common pitfalls, and confidently steward your financial future. We're going to build this understanding step by step. So setting up a rock-solid financial foundation, understanding who you can trust for advice, navigating insurance, which can be tricky, growing your wealth through smart investments, optimizing taxes, planning for a secure retirement, and then finally, making sure your legacy is set with effective estate planning.
Think of it as your shortcut to being well-informed. We've got some surprising facts and hopefully just enough humor to keep things interesting.
Let's jump right in because look, one of the biggest hurdles right at the start when you're trying to get your finances sorted is just knowing where to turn for help.
Yeah, that's huge.
Our sources really highlight this dilemma. Some people, they do too little planning, maybe relying on generic self-help stuff. Others try really hard, but they're using advice that isn't customized for them.
And then there's the issue of biased or sometimes even incompetent professionals. You see this play out in some pretty vivid stories.
Oh, yeah.
Well, consider Frank. He went to this career and investment coach named Chester. Sadly, Chester turned out to be dishonest, even lied on Frank's annuity application. So when the market corrected, Frank found out his investment was basically half what he expected. Imagine that stress looking for work and your safety net is just gone.
Oh, it's awful. And it's not always outright dishonesty, is it? Sometimes it's more about expertise being misapplied.
Exactly. The guide talks about Sally. She had this successful firm making computer casings. She met with a highly regarded broker, Jeff. Seemed great.
Okay.
But it was actually his assistant who ended up preparing her financial plan.
Oh.
And this led to her business expansion funds being misallocated. A huge waste of capital. It just highlights, even with a reputable firm, you got to be clear who's doing the work and what their actual expertise is.
That's such a critical point.
Yeah.
Which leads us right into finding the right professional. You hear this term a lot, fiduciary. What does that really mean?
Well, at its core, a fiduciary is someone who's legally or contractually obligated to act in your best interest. They have to put your needs above their own. A really profound position of trust.
I always thought fee-only advisors were the automatic safe bet. Like, no bias there.
Oh, that's a common assumption.
But this guide brings up something really interesting. It points out that even fee-only advisors can have a bias. If their fee is based on the assets they manage,
Right.
then recommending something that reduces those assets, maybe like a single-pay life insurance policy or a long-term care policy, even if it's in your best interest, well, that could subtly conflict with their incentive.
It's a nuanced point, isn't it?
Okay.
It doesn't mean they are biased, but the potential is there, just like with commissions. It really emphasizes trusting the individual advisor.
It really does. And this whole discussion brings up the regulatory environment itself. Regulation is obviously necessary, right? To protect people from, the dishonest types like Chester.
Absolutely. Without it, we wouldn't have disclosures, licensing standards.
But the guide also touches on how sometimes excessive regulation, maybe like that Department of Labor directive on fiduciaries for retirement funds, can have unintended consequences.
Yeah, like paradoxically leading to fewer product choices or maybe pushing experienced professionals into early retirement because the rules feel too burdensome. It's a tough balance.
It really is. Finding that sweet spot between protection and practicality. So let's break down the types of advisors you might encounter. Where do we start?
Okay, let's start with insurance agents. The guide actually notes that many can be incredibly sophisticated, analytically speaking, way beyond just selling a policy.
Interesting.
The key takeaway here, though, is to look for agents who represent multiple carriers.
Why is that?
So they can genuinely shop the market for you, get you the best fit, the best price for your needs, not just push one company's products. Makes sense, right?
Yeah, totally. Okay, next up, Investment Advisor Representatives, or IRRs.
Right. These folks are regulated at the federal and state levels. Now, passing an exam is necessary, of course, but the guide stresses it's just not enough for really comprehensive advice.
So what else do they need?
To properly guide you on asset allocation long-term planning, they really need sophisticated planning software. Specifically, software that includes Monte Carlo simulations. We'll definitely dig into why those are so important later.
Got it. Monte Carlo.
Okay. And then, for that really comprehensive financial planning, the true gold standard, according to these sources, are the Certified Financial Planners, CFPs, and Chartered Financial Consultants, CHFCs.
Why are they considered the gold standard?
Because they go through really broad and rigorous training across all 6 key areas of financial planning. What sets them apart is their ability to act as your sort of officer in charge. They coordinate the whole team of specialists. They see the big picture.
Okay, that makes sense. They're like the quarterback. Which brings us to those specialists you mentioned. CPAs, tax attorneys, estate planning attorneys, business brokers.
Very important roles.
Incredibly valuable, specialized expertise, absolutely. But the guide is very clear here. They should be brought in by your main financial planner at specific points.
Right. Not left to coordinate the whole strategy themselves.
Exactly, because their main training creates a natural bias. A CPA is fantastic at tax strategies, for example, but you don't want the tax tail wagging the financial planning dog, as the material puts it so well.
That phrase really sticks, doesn't it?
Yeah.
Such a good reminder to keep the main goals in focus.
Okay, so we've figured out, hopefully, how to find the right partners for this journey, but what's the very first step on the path itself?
The sources lay out this compelling idea. Building your financial future like a pyramid. You start with an absolutely solid foundation.
Prudence and priorities first.
Precisely. Securing your earning power, securing your assets with insurance, risk hedging techniques. All that comes before you even think about more aggressive growth strategies.
And a huge part of that foundation is your cash reserve.
Critical. The guide recommends a very structured 3-tiered approach here. Tier 1 is for totally liquid cash. Think 1 to 2 months of your known recurring monthly expenses.
So checking account, basic money market.
Exactly. Returns are low. That's not the point. Accessibility is key. It's for immediate needs.
Okay. Tier 1, immediate needs. What's Tier 2?
Tier 2 is your contingency fund. This is for those measurable, likely annual things, car maintenance, home repairs, maybe a planned vacation. But crucially, it also needs to cover vital contingencies like a brief disability, maybe a job loss, and all your insurance deductible.
All of them. Wow. How much should be in there?
Ideally, enough to cover at least 1 year of your expenses. And the investments here. They need to have, quote, negligible potential for market loss. Absolute security is the goal for this tier.
That phrase, negligible potential for market loss, it makes you think. Especially after hearing stories like the one about the 2008 crisis.
Oh, definitely.
Yeah.
The guide recounts this story about an advisor, Charles, having to tell his client, John, about a $40,000 loss.
Ouch. In what?
In what John thought was a safe, aggressive money market fund. It just shattered that misconception that money market funds are totally risk-free.
Yeah.
It really hits home why Tier 2 needs to be so secure.
Yeah, absolutely. Okay, so Tiers 1 and 2 are about safety and near-term needs. What's Tier 3?
Tier 3 is for contingent expenses. Think of it as your 10-year fund. For those larger, less frequent, but still possible expenses. Maybe a major home renovation that isn't an emergency, or a significant medical cost that insurance doesn't fully cover.
So this one can have a bit more risk.
A little bit, yes. Some market exposure is okay here, but still less risk than your true long-term investments. The key is, only once these 3 tiers are properly filled, should your excess money flow into longer-term growth strategies. Build that base first.
Build the base. Got it. Okay. Beyond cash, what about debt? How should we approach that prudently?
Well, for mortgages, there's a really simple but powerful secret. Make just 1 or 2 extra payments per year.
Really? Does that make a big difference?
Huge. If your lender credits those early payments correctly, and you absolutely must confirm this, it can potentially cut a 30-year mortgage down to around 20 years. Think of the interest savings.
Wow, that's significant. But you mentioned a caution.
Yeah, be careful about refinancing for the same old term, like another 30 years, just to lower your monthly payment a bit. That just extends your debt for decades longer. Don't trade short-term cash flow for long-term debt.
Good point. And what about the dreaded credit cards?
Ah, yes. The trap. Minimum payments mostly just cover interest, right? So the debt can stick around forever.
Feels like it sometimes.
But here's a fascinating little secret the guide reveals about building credit.
Oh,
paying twice the minimum payment can actually help your credit score. Apparently, creditors want to earn some interest.
So paying it off completely before interest hits might actually lower your score sometimes.
It sounds strange, but yes, sometimes. It limits their earning potential, so paying a bit more than the minimum, but still allowing some interest to accrue can be viewed positively. It's a weird quirk, but definitely an incentive to pay down quickly.
That is weird. Okay, and a big warning from the sources.
Huge warning. Never, ever, ever consider credit accounts as part of your cash reserve.
Why not? It's available credit, right?
It's available debt. The guide tells the story of Bill. He impulsively paid off his half of the mortgage, thought he was debt-free, but he was jointly and severally obligated, meaning he was still responsible for the whole thing if his partner couldn't pay. Combine that with his total lack of budgeting discipline, it led to utter financial chaos. Credit is not a safety net. It's debt.
Okay, message received. Credit equals debt, not reserve cash. So, we've built the foundation, managed debt. Now let's talk about protecting it all. Risk management, insurance. Why even buy insurance?
Well, at its heart, it's about hedging. Hedging against those individual financial catastrophes, things that are statistically rare for the insurance company across all its policyholders, but would be utterly devastating for you personally if they happened.
Like a long-term disability or a major health event.
Exactly. You can't predict your lifespan. You can't predict your health with certainty. So insurance acts as that crucial safety net for the unpredictable.
Okay. So where should you prioritize your insurance focus? What's most important?
The guide is pretty strong on this. After basic health insurance, disability income insurance, DI, is arguably the most critical coverage you can have.
More critical than life insurance?
For many people, yes, especially during their working years. Think about it. If you become disabled, your expenses often go up. More medical costs, maybe modifications needed.
Yeah, that makes sense.
But your income can just stop, halt completely. It's a double whammy.
Okay, so DI is crucial. Any tips on getting it affordably?
Yes. This links back to our cash reserves. Having that robust Tier 2 cash reserve allows you to choose a longer elimination period.
That's the waiting period before benefits start.
Exactly. If you can cover your own expenses for, say, 90 or 180 days using your reserves, you can select a policy with that longer waiting period, and that can dramatically cut your premium costs.
Smart. It all connects. The guide mentioned a story about someone named Max.
Right, Max. He was apparently so focused on aggressive investing, he kind of overlooked DI. His advisor had to gently push him on it. It actually brought up some deeper issues in his relationship with his wife, Jenny. It just shows that these insurance conversations, they're often not just about the numbers. They touch on love, responsibility, how we care for each other.
That's a really powerful point.
Yeah.
Okay, beyond DI, what about other health coverages? HSAs, FSAs?
Yeah, health savings accounts, HSAs, are particularly potent tools if you have a high deductible health plan. You get pre-tax contributions,
Nice.
tax-free growth on the money inside the account,
Also nice.
and tax-free withdrawals for qualified medical expenses. Plus, the money rolls over year after year. It's a triple tax advantage. Really powerful.
And FSAs, flexible spending accounts.
FSAs also let you contribute pre-tax money for medical or dependent care costs. The main difference is they usually have a use it or lose it rule each year.
Ah, okay. So you have to be careful planning your contributions.
Right. Though some employers might let you access the full year's deduction up front, interest-free, which can be helpful. Each has its place. Depends on your situation.
Okay. Then there's life insurance. The guide makes it clear it's way more than just a death benefit.
Absolutely. Take Universal Life, or UL. Think of it as a flexible premium policy with a cash value component, often designed to provide coverage well past age 100.
And there's a specific type, equity indexed UL.
Right, IUL. This is often preferred because it kind of offers the best of both worlds.
Yeah.
It protects you against market loss. You're typically guaranteed zero interest if the underlying index falls, but you still get to participate in a portion of the market gains.
How much participation?
Often something like 30% to 60%, usually with a cap on the upside. So it offers downside protection with some growth potential. It's an intriguing blend.
The guide mentioned a story about policy options, option A versus option B.
Yes, a tough lesson for Harold's widow, Karen. Harold had chosen option A on his UL policy. That meant his death benefits stayed level. It didn't increase as his cash value grew. So he'd made a large bonus deposit into the policy, building up cash value. But when the policy later lapsed for other reasons, that extra cash value didn't increase the death benefit Karen received. It was essentially lost in terms of the payout.
Ouch. What would option B have done?
Option B typically sets the death benefit equal to the original amount plus the current cash value. It's usually more expensive, sure, but for Harold's family, it would have meant a much larger payout. A really key detail to understand when choosing.
Definitely. And the guide mentions something really innovative. Using certain life insurance policies almost like a Roth IRA.
Yeah, the Roth emulator concept. If you strategically overfund certain low-cost UL policies, structured very carefully to avoid becoming a modified endowment contract, or MEC.
Okay, avoiding MEC status is key.
Absolutely critical. If you do that, the cash value can grow tax-sheltered. Then you can access that cash value later through tax-free policy loans. It effectively acts like an additional Roth account, especially useful if you've maxed out your regular Roth contributions.
That sounds incredibly powerful for tax planning.
It can be, but it's crucial that these policies have strong no-lapse guarantees, especially variable life policies where the cash value is directly invested. Without that guarantee, market losses could wipe out the cash value, causing the policy to lapse or forcing you to pay much higher premiums just when you can least afford it.
So guarantees are vital, and life insurance isn't just about death benefits or Roth emulation.
Not at all. It provides spousal income replacement. Think about Mrs. Lennox and the guide her ex-husband canceled the policy meant to replace her waived survivor pension benefit. Huge blow.
Wow.
It can also provide estate tax liquidity cash to pay estate taxes so your heirs don't have to sell off other assets like a family business or farm at a bad time.
And it can be combined with long-term care coverage.
Yes, through combo or hybrid policies. It's a really versatile tool when used correctly.
Okay, speaking of long-term care, LTC policies specifically, these cover chronic care that regular health insurance or Medicare generally don't write.
Yeah, exactly. Things like needing help with daily activities over a long period. The guide suggests the smartest buy is often a large pooled benefit for spouses.
Pooled, meaning?
Meaning the total benefit amount is shared. Either partner can draw from it as needed up to the total limit. More flexible than two separate policies.
And the trigger for benefits is really important.
Absolutely critical. Look for policies that trigger based on the inability to perform 2 of 6 activities of daily living. Things like bathing, dressing, eating. That's generally much better and more flexible than policies requiring actual nursing home confinement.
Good tip. And cost savings.
You can find efficiency with single premium combo policies. And just like with DI, choosing a longer waiting period, if your Tier 2 reserves allow it, can significantly cut premiums.
The story about Nadine really illustrated the power of planning here.
It really did. She was in a nursing home, savings dwindling fast. Her son found a specific type of annuity, medically underwritten, that provided a much higher payout specifically for her nursing home costs.
And the result?
It allowed her to preserve a significant inheritance for her kids, which lifted a huge emotional burden. It shows how creative financial solutions can preserve dignity and legacy.
That's amazing. Okay, shifting gears slightly, identity theft. It's everywhere now. What kind of protection do we need?
It's not just about getting alerts that your data might have been compromised. You need actual loss insurance and access to specialists who will do the legwork to repair any credit damage for you. That can be incredibly time-consuming.
Good point. Any practical tips?
The guide offers a clever one for real estate closings. Since property sales are public, fees sometimes target closing funds. So, create a new bank account just before the closing and only give the deposit info at the very last minute. Reduces the window of opportunity.
Smart. What about all those extended warranties they push on you for cars, appliances, tools? Worth it?
Generally, no. Our sources are pretty clear. Most are too expensive for the potential benefit.
So what's the alternative?
Build up that Tier 2 cash reserve. Self-insure for those repairs and replacements. It's usually more cost-effective.
Any except.
The only time it might make sense is using the potential purchase of an extended warranty as a bargaining chip when negotiating a car's price. But otherwise, probably best to skip them.
Okay. And finally, on insurance, how do we know if the carrier itself is reliable?
Good question. There's an industry secret the guide mentions. Insurers owned by venture capital firms might keep lower reserves, invested more aggressively than traditional regulated carriers.
So how do you check?
Look up their AM Best rating. It's like a credit score for insurers. The guide suggests maybe mentally reducing the rating by a notch if it's VC owned, just as a precaution. Also look at their solvency ratios, how much capital they have versus their obligations.
And there are state guarantee funds.
Yes, they act like the FDIC for banks, providing a safety net if an insurer fails. but they have limits. And importantly, agents are legally prohibited from using these guarantees as a selling point. So you still need to do your own due diligence on the carrier's financial strength.
Okay, foundation built, protections in place. Let's talk about growing wealth. Accumulation investment strategies. You mentioned Monte Carlo simulations earlier.
Yes, a real game changer. Traditional planning often just projects a fixed rate of return, like say 6% or 7% per year.
Which is totally unrealistic, right? The market goes up and down.
Exactly.
Yeah.
Monte Carlo's different. It runs thousands, sometimes tens of thousands, of random scenarios based on actual historical market volatility. The booms, the busts, everything in between.
So what does it tell you?
It doesn't predict the future, but it shows you the likelihood or the probability of reaching your financial goals without running out of money. Like, there's a 90% probability your portfolio will last until age 95 based on your current plan.
Okay, that feels much more useful for making decisions, adjusting your budget, maybe your investment mix.
Precisely. It empowers you to make informed choices. One quick note, though. Really complex strategies, like maximizing certain types of pensions, often can't be modeled this way and need separate specialized analysis.
Got it. Now, the sources critique some common investment approaches. First up, target date funds. Popular in 401k.
Very popular, yes.
Yeah.
But the guide calls them folly.
Folly, why?
Because their automatic adjustments getting more conservative as you near retirement are typically designed to protect the employer from regulatory headaches, not necessarily to match your specific required rate of return or your personal budget needs. It's a standardized solution for a very personal problem.
Interesting perspective. What about DIY investing? Just picking funds that did well last year.
Rearview mirror investing, a classic trap.
Yeah.
Assuming past winners will keep winning or thinking just scattering your money randomly across a few funds is good diversification.
So what's the key then?
The guide hammers this home. Over 90% of your long-term investment return comes down to asset class allocation, how you divide your money between stocks, bonds, real estate, cash, etc. That's far more important than picking the hot individual fund manager.
That really shifts the focus, doesn't it? From stock picking to strategic allocation.
Absolutely. It's about the big picture structure.
What about active versus passive management? The whole index funds versus managed funds debate.
The guide touches on this. Active managers often do beat their benchmarks before you account for their fees.
The fees.
After fees, most fail to provide positive alpha that's risk-adjusted extra return above the benchmark. You should definitely check those measures. Alpha and also beta, which tells you how volatile a fund is compared to the market. Look at the net results after all costs.
Okay. How about real estate investing? Directly owning rental properties.
The guide is pretty cautious here. It mentions the hassles, irritations, collection duties, maintenance excuses, endless. Being a landlord isn't for everyone.
Yeah, I can imagine.
And there's a cautionary tale about Mark. His own son sold him units in a real estate investment trust, a REIT. Turned out it was paying distributions using money from new investors. Basically resembled a Ponzi scheme.
Oh, wow. That's rough. So what's the recommended way to invest in real estate then?
Through diversified vehicles. Think mutual funds or ETFs that specialize in REITs. You get exposure to real estate without the direct ownership headaches.
Or using it differently.
Or creatively, like buying a condo for your child to live in while at college. That can significantly cut down on those hefty room and board expenses.
Smart. Speaking of college, 529 plans. How do those work?
Great tools. Two main types. Prepaid tuition plans, which lock in tuition rates at specific state schools, and savings plans, which work more like investment accounts.
Tax advantages.
Big time. Money grows tax deferred. And withdrawals are tax-free if used for qualified education expenses. Plus, they're flexible. You can usually change the beneficiary, even to yourself if needed.
Any tips on choosing one?
Consider splitting your money. Maybe put some in your state's plan, which might offer state tax benefits or lower fees, and some in a privately managed plan, which often provides more investment choices. Diversify your approach.
Okay, good strategy. Now let's pivot to taxes. Optimizing income tax management. What's the main principle here?
The guide sums it up perfectly. Don't let the tax tail wag the financial planning dog.
Love that phrase. Meaning,
tax minimization is important, it's an efficiency guideline, but it shouldn't be the ultimate goal. Your core financial objectives, your overall plan, prudent stewardship, those come first. Don't make a bad financial decision just to save a little tax.
Makes sense. The guide uses a tax triangle model.
Yeah, it's a helpful way to visualize things. First corner, taxed in, taxed out. These are your non-qualified accounts like a regular brokerage account. You invest money you've already paid taxes on after tax. And then any earnings, dividends, interest, capital gains are taxed annually.
Straightforward, but maybe less efficient.
Generally, yes.
Yeah.
Second quarter, pre-tax in, taxed out. These are your traditional retirement accounts, 401ks, traditional IRAs. You contribute money before taxes are taken out, lowering your current taxable income.
Nice.
The money grows tax deferred, meaning you don't pay taxes year after year on the growth. But eventually, when you withdraw the money in retirement, those withdrawals are taxed as ordinary income.
Okay, tax break now, pay taxes later.
Exactly. And the third corner, often the most powerful, after tax in, tax-free out.
This sounds good. What's in here?
This includes Roth accounts, Roth IRA, Roth 401k, health savings accounts, HSAs, when used for medical expenses, and those specially structured life insurance policies we talked about earlier, accessed via loans.
How does it work?
You contribute money you've already paid taxes on, after tax. But then, the growth is tax-free, and qualified withdrawals later on are completely tax-free. No taxes on the back end.
That offers huge long-term tax advantages.
Potentially, yes. Especially if you expect to be in a higher tax bracket in retirement.
Which brings us to Roth conversions. Moving money from a traditional pre-tax account to an after-tax Roth. When does this make sense?
It's a big decision with upfront tax costs. The guide highlights key factors. First, do you strongly expect to be in a substantially higher tax bracket in retirement than you are now?
Okay, pay tax now at a lower rate.
Right. Second, are you capturing significant investment gains that can then grow tax-free inside the Roth? And third, do you have many, many years for that tax-free growth to compound and essentially pay back the taxes you paid on the conversion?
It's not a slam dunk, then.
Definitely not. And that waiver of the early withdrawal penalty if you're under 59 and a half, the guide calls that scant compensation for the very real tax bill you'll pay if the conversion isn't strategically sound for the long haul. It needs careful analysis.
Okay. What about dividends? Qualified versus non-qualified.
Good distinction. Qualified dividends, usually from stocks and mutual funds held for a certain period, get preferential tax treatment at the federal level, 0%, 15%, or 20% depending on your overall income. Much better than ordinary income rates.
So reinvesting those is often smart.
Often, yes, if you don't need the income. Non-qualified dividends, like from some REITs or certain foreign companies, are taxed at your regular, usually higher, ordinary income tax rate.
Got it. What if you need to sell investments, maybe to buy one of those hybrid insurance policies, or just rebalance your portfolio more efficiently? How do taxes play in?
You absolutely have to model the tax consequences first. Selling appreciated assets triggers capital gains tax. You need to know that number.
Can you manage the tax hit?
Sometimes, yes. Consider staging the liquidations over several tax years instead of all at once. This might keep you in a lower capital gains bracket each year.
The guide had an example, Joe.
Right, Joe. He actually realized a loss when selling some stocks to buy an equity index annuity. This not only got him the protection he wanted from the annuity, but also strategically lowered his overall capital gains tax bill for the year. It's about seeing the whole tax picture.
Smart planning. Any current tax things to be aware of?
For higher earners, yeah. There's the net investment income tax, or NIIT, which is an extra 3.8% surcharge on investment income above certain thresholds. And there's effectively about a 1% surtax on earned income for high earners too, through increased Medicare taxes. Just things to factor into your planning if they apply to you.
Okay, lots to consider on the tax front. Now, let's look ahead to retirement planning. Securing those golden years. What are the critical things we often miss?
One huge one, often overlooked, is the order of returns and losses, or sometimes called sequence risk.
Sequence risk, what's that?
It's the order in which you experience investment gains and losses, especially right when you retire and start taking money out. Even if your average return over 20 or 30 years is decent, having a few bad years right at the beginning can devastate your portfolio.
Why?
Because you're selling assets when they're down to fund your withdrawals. This depletes your principal much faster than if the good years came first. It dramatically impacts how long your money might last. It's a really strong argument for managing risk as retirement approaches.
That makes intuitive sense, but I hadn't thought of it quite like that. Okay, what about rollovers? Leaving a job, moving your 401k?
Big decision. You can usually roll it into an IRA. There are pros and cons. One key difference can be creditor protection, which varies significantly by state between 401ks and IRAs. Worth looking into for your specific state.
And the guide debunks a myth here.
Yeah, the idea that leaving money in your old employer's 401k shows loyalty or helps your chances of getting rehired later.
It's not true.
According to the source, nope. It can actually create administrative headaches for the old employer under Department of Labor rules, potentially making them less likely to rehire you. Colbert's story in the guide illustrates this. Don't let misplaced sentiment drive financial decisions.
Good to know. Okay, Social Security. So many claiming options. It's bewildering.
It really is. Thousands of possibilities. The guide highlights one strategy for couples called the split age strategy.
Who is that good for?
It works well for couples where there's a big difference in benefit amounts, and the spouse with the larger benefit might have a shorter life expectancy.
How does it work?
The spouse with the lower benefit, and potentially a longer lifespan, claims their reduced benefit early, maybe at 62. The other spouse, with the higher benefit, delays claiming until age 70 to maximize their benefit amount. This maximizes the higher benefit for the surviving spouse later on.
Interesting strategy. And that file and suspend trick?
Gone. That popular strategy for couples ended back in 2016, so don't count on that one.
Also, there's an earnings limit if you claim early and keep working?
Yes, absolutely. If you claim Social Security before your full retirement age and earn over a certain threshold, it was around $17,000 in 2018, it adjusts yearly. Your benefits get reduced, typically $1 withheld for every $2 earned above the limit.
Ouch. How do people manage that?
Well, some might negotiate for non-taxable benefits instead of salary, or perhaps start a business where they have more control over their taxable income flow. It takes careful planning if you want to work and claim early.
Okay. What about protecting against living too long, running out of money late in life?
That's where longevity annuities come in. They're also called QLACs, Qualified Longevity Annuity Contracts. Relatively new product type.
How do they work?
You use a portion of your retirement savings to buy a guaranteed income stream that starts much later in life, typically age 80 or 85. Because there's no cash value and the payout is delayed so long, the income rate is much higher than a standard immediate annuity. It's pure longevity insurance.
A hedge against outliving your money. Makes sense. What about bonds? Any specific strategies?
For individual bonds, the guide mentions staggered bonds or bond laddering. You buy bonds with different maturity dates, some short-term, some mid-term, some long-term.
Why stagger them?
It helps manage interest rate risk. If rates go up, you have shorter-term bonds maturing soon that you can reinvest at the higher rates. If rates go down, you still have your longer-term bonds locked in at the older, higher rates. It smooths things out.
Smart diversification within bonds. Okay, back to annuities for a second. Those equity indexed annuities, EIAs, they sometimes have special riders.
Yes, income double riders are valuable ones. These can literally double your guaranteed income payout from the annuity for a set period, maybe 4 or 5 years.
What triggers the doubling?
Usually a long-term care need, like being unable to perform 2 activities of daily living, or ADLs, or being confined to a nursing home.
Is that income taxable?
Yes, the annuity income is generally taxable. But having double the income during a costly LTC event can be incredibly helpful. The best versions only charge the rider fee against the cash value, not the guaranteed income account value, which protects your base income.
Okay, good detail. And actually getting money out of annuities, what are the main ways?
3 main ways discussed. First, on-demand withdrawals. Just taking money out periodically. Often comes with surrender charges early on that decrease over time.
The catch.
The big catch is that taking withdrawals, especially early or large ones, can really compromise or even void the guarantees, like the guaranteed income rider that you bought the annuity for in the first place. Be careful.
Okay, second method.
Annuitizing. This means you trade your account value, all or part of it, for the highest possible guaranteed income stream for life, or a set period. You give up the principal for the guaranteed payout.
Do people do this often?
Less often these days. People are generally reluctant to give up control of their principal. But sometimes, older annuity contracts might have very favorable annuitization rates built in that are worth looking at.
Interesting. And the third way?
Those guaranteed withdrawal riders we mentioned, these are very common now. They create a separate income account value, or IAV.
Different from the actual cash value.
Yes, often distinct. The IAV typically grows at a guaranteed rate, say 5% or 6% per year, purely for the purpose of calculating your future guaranteed lifetime withdrawal amount. Your actual cash value fluctuates with the market index, but your income base keeps growing.
Can the income go up if the market does well?
The best riders allow for that, yes. If the index performance boosts your actual account value significantly, your IAV might ratchet up or step up to that higher value, permanently increasing your guaranteed income base. Though this step-up feature often stops around age 80, it provides a floor with some potential upside for your income.
Okay, that covers retirement income pretty well. Now the final piece, estate planning. The guide calls this the ignored essential.
So true. It's often the last thing people get to, if at all. But it's so profoundly connected to our beliefs, our relationships, our legacy.
It's not just about who gets what when you die, is it?
Not at all. It's about arranging your affairs for potential incompetence before death, as well as after. It covers privacy, lawsuit protection, minimizing taxes, and making sure your assets go where you truly intend them to go. It's your final act of stewardship.
So what are the absolute must-have documents?
Okay, wills and codicils, which are amendments to wills, essential for defining your wishes. But critically, they must be properly witnessed according to your state's laws.
And recorded.
Ideally, yes. Recording it at the clerk of superior court helps prevent it from being challenged or simply disappearing.
Yeah.
And please, use an attorney for this. The state law is complex. This is not a DIY job.
Absolutely. What about healthcare decisions if you can't make them yourself?
That's where a healthcare power of attorney, or HCPA, comes in. The guide emphasizes this is much more comprehensive than a simple living will.
How so?
It designates someone you trust your agent to make healthcare decisions for you. But you can also include specific guidelines in it about end-of-life care, reflecting your personal values. This takes a huge burden off your agent during a really difficult time. They're following your wishes.
That seems incredibly important for peace of mind. Other powers of attorney.
Yes, for non-healthcare matters, financial decisions, legal matters. These can be broad, covering everything, or specific just for certain tasks. They can be durable, meaning they stay in effect, even if you become incapacitated, or temporary, often triggered by a doctor certifying incompetence.
And keeping track of everything. Assets, passwords.
Essential. Checklists and a fireproof safe. Your attorney, in fact, the person named in your power of attorney, or your executor, the person handling your estate after death, needs access to all your vital documents. Asset statements, insurance contracts, IDs, digital passwords. Think of it as creating an instruction manual for wrapping up your affairs.
Okay. Titling property correctly. You mentioned this can cause problems.
Huge problems, often unintentionally. A common one is joint tenants with right of survivorship, or JTWRS.
How does that work?
It means when one joint owner dies, their share automatically passes directly to the surviving joint owner. It completely bypasses the will.
So what's the problem?
It can inadvertently disinherit people you intended to provide for in your will. Say you remarry and put your new spouse on the house deed as JTWRS, thinking your will takes care of your kids from a prior marriage. Nope. If you die first, the house goes entirely to your spouse, regardless of your will. Your kids might get nothing from that asset.
Wow, that's a major pitfall. The Leonard story highlighted this too.
Yes, Leonard's story was about waiting too long. He developed memory issues, and then complexities arose with co-trustees and joint accounts. The key warning was that any joint tenant can take assets. Only one signature or access order is required. Waiting until someone is mentally impaired to update documents just invites legal challenges and family conflict. Proactive planning is key.
So true. Any special points about real estate?
Yes, specific deed language matters. Things like a conventional life estate can allow someone to live in a property for their lifetime, but keep the property out of their countable assets for Medicaid or out of their taxable estate. Also, be aware of rights that run with the land, like mineral rights or easements.
And encroachments.
Things like a neighbor's fence or driveway being accidentally built slightly over your property line. These might seem minor, but they can actually prevent you from selling the property until the encroachment is legally resolved or cured. Always get a survey.
Good practical advice. Okay, beneficiary designations. We talked about forms trumping wills.
Absolutely critical reminder. Beneficiary forms on your IRAs, 401k, life insurance policies, annuities. These always override whatever your will says about those specific assets. Always keep them updated after major life events, like marriage, divorce, birth, death.
And the term per stirpes, why is that important?
Per stirpes, Latin, meaning by roots or by branch. It's crucial for ensuring your inheritance flows down family lines as you likely intend.
Can you give an example?
Sure. Say you name your two children, Alice and Bob, as primary beneficiaries, 50-50. If Alice dies before you, what happens to her 50% share?
Good question.
If you designated per stirpes, Alice's share automatically goes to her children, her grandchildren. If you didn't use per stirpes, or the plan doesn't allow it, Alice's share might instead go entirely to your surviving child, Bob, potentially disinheriting Alice's kids. A huge difference from a small phrase.
Wow. Okay. Definitely need to check for per stirpes.
Yeah.
What about disclaiming inheritance?
Briefly mentioned, yes. It's an option where a named beneficiary can formally refuse or disclaim an inheritance.
Why would they do that?
Maybe the beneficiary doesn't need the money themselves, but knows the next person in line, like their own child or perhaps a sibling, needs it more. If allowed by the plan documents, disclaiming lets the asset pass directly to that contingent beneficiary, potentially avoiding extra taxes or complications. Needs careful legal advice, though.
Okay. For larger estates, taxes become a factor again.
Yes, if your total estate value exceeds the federal estate tax exemption threshold, which was very high, over $11 million per person in 2018, but it changes, then estate taxes apply. And watch out. Assets you gave away within 3 years of your death can sometimes be clawed back and added to your taxable estate.
So how do people manage estate taxes if they're above the limit?
Irrevocable life insurance trusts, or ILITs, are a key tool. You create a trust. The trust applies for and owns your life insurance policy. You make gifts to the trust to pay the premiums.
And the benefit.
Since you don't own the policy, the death benefit is paid to the trust outside of your taxable estate. The trust can then use that tax-free cash to pay any estate taxes due without forcing your heirs to sell off other assets like a family business or farm, perhaps at a fair sale price. It provides crucial liquidity.
Very smart. What about charitable giving and estate planning?
Charitable trusts are powerful tools here. Things like GRATs, Grant or Retained Annuity Trusts, or CRUTs, Charitable Remainder Unit Trusts.
How do they work, generally?
You transfer an appreciated asset, like stock, into the trust. You, or a loved one, can receive an income stream from the trust for life, or a set number of years. You often get an immediate income tax deduction for the gift portion, and the asset is removed from your taxable estate.
And eventually,
whatever principal remains in the trust goes to your chosen charity. It's a way to benefit yourself or family now, reduce taxes, and make a significant charitable gift later. A real win-win-win.
Great option for philanthropic folks. And lastly, testamentary trusts. Created by a will.
Yes, these trusts only come into existence upon your death, as directed by your will. Mara's story in the guide is a good example. She used one to set conditions for her daughter, Celine.
Conditions like what?
Like maybe tying distributions to Celine maintaining sobriety, or holding a job incentives to straighten out her life, as the guide put it. You can fund these trusts with life insurance proceeds or other assets like stock, and provide very specific instructions on how the money should be managed and distributed for the beneficiary's benefit. It allows you to maintain some control and express your values even after you're gone.
It really covers the whole spectrum, doesn't it?
It truly aims for a comprehensive approach to stewardship.
Well, what a journey we've been on today through this intricate, sometimes really bewildering world of financial planning.
It definitely has its complexities.
We started right at the beginning, building those foundational cash reserves, managing debt smartly. Then we navigated the world of insurance, looked at savvy investment and accumulation strategies, ways to optimize taxes.
Planning for those crucial retirement years.
And finally, securing your legacy through thoughtful estate planning. If there's one central thread through all of this, it seems to be the immense power of informed, proactive planning.
Absolutely. That and finding the right, truly unbiased expertise to help guide you along the way.
Exactly. And ultimately, successful financial planning, as these sources suggest, it isn't really about maximizing wealth just for its own sake. It's not about dying with the most toys.
No, it's framed more as the prudent stewardship of money. It's about taking care of your responsibilities, guaranteeing that care for your loved ones, and then thinking thoughtfully about how any surplus can be used for, moral and prudent purposes beyond just accumulation.
Ensuring you die with the most prudently stewarded resources. That's a different way to think about winning.
It is indeed.
So the final question for you listening, how will you define and pursue that kind of winning in your own financial life? Definitely something to think about.